Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending January 10th, 2025. Appreciate you all tuning in to this channel, liking and subscribing. And I'm host Justin Klein, and make sure you hit that notification bell as well. Now, this week I'm titling the video Inflation Fears Spark Higher Rates and an Equity Drop. And that is the story of this last week. This is the heat map of the S&P 500, and you can see here that Apple, Nvidia, Amazon, most of the major big names were down. Only Meta, Tesla, Walmart were up, Eli Lilly a little bit, United Health. But besides that, you saw a lot of red. Netflix down 6%, Oracle down 7%, Adobe down 5.5%, even Berkshire and JP Morgan and AMD, so a lot of red here on the screen, even Visa and MasterCard taking it on the chin a bit. And you can tell too, this is the price, this is ranking them based on price to sales ratio. So actually, let me get, let's say no group. So what you can see here is actually, let's group it by sector. You can see the bigger names are more expensive. Palantir down 10%, and you can see, for most sectors, the larger the price of sales, the more downside there was in the stock on the week. Now, there's obviously caveats to this, but in general, that's kind of how it worked. And what happens is when you have higher rates, you get multiple contraction, and that's what you got in a lot of cases this week. And I'll dig into the charts in a bit, but what you'll see is inflation expectations as well as rates are moving higher. Now, on the economic news front, you had durable goods that came in a bit lower on Monday. Then you had ISM manufacturing PMI that came in a bit higher, though, PMI up to 54.1. But the big story on that was the services prices paid index up to 64.4, the highest level in, let's see, since February of last year. Sorry, February of 2023. I got used to that now. We're in a new year. This is almost the highest level of services inflation since in the last 2 years. And that will likely mean that the CPI figures that come out in the coming week are headed higher. And I'll show you how some market data is saying, inflation is likely to reaccelerate. And now you had consumer credit outstanding that dipped, so that was interesting. Consumers borrowing less. That would be something to watch. See if that's a blip like it was back in August, or is that a trend? But we'll follow up on that next month. Continued claims for unemployment insurance that did tick up, but is coming down. So the jobs market, I think overall is okay. Average hourly earnings year over year ticked down a little bit, but still kind of still bottomed back in July. Non-farm payrolls did tick up a little bit, but there was some color to that, and this kind of sums it up here: 256,000, and the expectation was 150 to 160,000. So certainly beat expectations. Unemployment rate did tick down from 4.2 to 4.1, and you had cooler average hourly earnings up 0.3% month over month, which was kind of in line with consensus, but down from November's 0.4%. And then if you look at sector, really it was healthcare had the biggest gain. Retail also did well, so the consumer continues to spend. Leisure, hospitality, obviously there's a lot of demand as a lot of people have moved out of that sector. But manufacturing did fall 13,000 for the month. And this picture shows that the Fed is likely to continue to pause and maybe even could be on the path to raising rates next. And that's what you see here. This is the Fed meeting coming up in just a couple of weeks, the 29th of January. The overwhelming odds are that there will be a pause, 93% chance that they will do nothing. You don't get until kind of June when you see the expectations of an actual cut being priced in. Even May, there's still a little bit better chance that there will be a pause than one cut, but certainly possible there could be a cut. But what you can see is these expectations have dropped over the past couple of months. You go out to December of this year, excuse me. Gotta get used to that now. The odds that we were a month ago was that we were going to get all the way basically to 375 to 400, so that'd be 2 cuts by year end. That was a month ago. Now the odds that where the rates will be at the end of the year is that the highest likelihood is actually 1 cut from here. And there's actually a 13% chance of no cuts, whereas a month ago it was only 5.1. So expectations for the Fed easing Fed policy, it continues to be setback. And I'll get into some of the charts here now. And this is the ProShares inflation expectations ETF. And what you can see is this is breaking out to a degree, okay? And that is something that we have to take into account, is the market is starting to think that the Fed is going to, or that inflation is headed higher. Here's the 5-year break even. Now that debt is coming from a low of 2.17, now we're up 2.32. This is not really breaking out. This is as of the 9th. This is a couple days old, but the most updated shows you that you had a surge over the past couple days. So the market is expecting inflation to head higher, and that means rates are moving higher. Here's the IEF, the 10-year, continuing to sell off here. You are getting strength in the dollar as well, and ultimately that is tightening policy, or tightening financial conditions, shall we say, and something to be on the lookout for, that this could be ushering in a bit of a stagflationary environment. A lot will depend on policy. We said that here many times, that the new Trump administration will have a lot of volatility to the ultimate policy that is implemented, especially compared to the rhetoric. He's not king. He still has to go through Congress for a lot of things, and the reality is there's a lot of constituencies with opposing views on how to deal with many aspects of governing. And so what will actually be implemented is likely to be very different than just the rhetoric. And so we have to watch for kind of the facts on the ground. Now, this is the treasury, not treasury, the yield spreads. And so this is short-term junk to short-term treasuries. So when this is going higher, it means the credit market is holding in there. Now, what I will say is you have that move down back on the 18th of December. This has just been chapping sideways. This is a bearish pattern. So this is likely to head lower, and it would not shock me if this takes another leg lower, and thus the equity markets take a leg lower. Here's the S&P here. Let me clean this up a bit. This is actually the major support level, so I'll leave that. Let me delete some of these things. Let's cut that one. Let's cut that one. That is a fib, and I'll cut this one as well. There we go. Clean that up. Now I'm leaving these in here because this was the first support level. We hit that. This is no longer support. We bounced. We basically broke it on Friday, and we're at the 100-day moving average. That's this green line here. But we kind of hit it back in August, or we did hit it with that broad sell-off, and then we bounced and found support again at it in September. So we've hit it a couple times over the past 6 months or so, and it's going to be less support. Now, the next major support, I believe, is around this 5,700 on the S&P. I do think we head there probably in the near term. Probably get a bounce, but ultimately, I think we could see 5450 being tested in the coming, let's call it, 2 quarters. I think that's the market needs it. The market needs a refresh. Sentiment perspective has gotten I'd say offsides, and there's not a lot of cash left. And it means that upside surprises are difficult to come by, and therefore this is likely a period where you're going to see a bit elevated volatility. You can see that with the VIX here. This is a bullish pattern as well, and look at the MACD now above the 0 line, and it shows you that the VIX is trending higher, and that is negative for asset prices in the near term. Also, the strong dollar. This is adjusted for year-end tax distribution, but basically this is. I'll pull up. Let me go here. Give you a cleaner view of the dollar index. There we go. Why is that giving me that? I don't want that number. There we go. let's just go with, there we go, real trade weighted. I'm sorry. Let's bring up this trade weighted dollar index. Yeah, there we go, 129. So you can see how just powerfully strong this trend is on the dollar, and that is negative once again for risk assets. And so I do expect it to reverse this year. However, just a heads up, I do expect it to reverse as I think the Fed may allow inflation to run hot. They may stop cutting, but are they actually going to raise rates? I think they might be frozen and just kind of do nothing for a little while until something untenable happens. And if you see inflation rising and the Fed not raising rates or tightening policy in order to uh, combat the inflation, I could easily see the dollar falling. It gives a lack of credibility of the Fed. I also see potential of end of QT. That's probably even more important than what the Fed is going to do with the rates. And lots to do with liquidity in the system and making sure that they can fund, the treasury market issuance, which is going to be dramatic this year. So a lot of what we talked about with rates is kind of a sideshow there. So I wanted to highlight that because it's really important to understand in context the important factors that are happening in markets, and it has less to do with rates and uh, a lot more to do with the Fed balance sheet and QT. And I think that will be the story in the first half of this year because I don't think the Fed is likely to move much in the first half. Let's get to gold. Gold is strong. I just showed you the dollar, and look how strong gold is. Right, the dollar is very strong, and this is at a modest pullback. This is just a choppy corrective period. I think and look at the volume on gold on Friday. On that move higher. This is just a bastion of strength, especially relative to what you're seeing in the dollar, and something I really wanted to highlight because I do think that you continue to see a good a bullish market in precious metals. The move index that has moved up but not breaking out, so this is an indication that while we might be in a corrective period, it's not a corrective period that it should be dramatically sold. In fact, my base case is that we get a modest sell-off in the markets, maybe similar to, I'll go back out to 2022. I think you could have a similar type of year or similar type of sell-off we did at the beginning of 2022, like this, and then we get a rally. You could even, but I think you might even see a new high as the Fed doesn't tighten policy with inflation reaccelerating, and liquidity remains relatively robust, and then I think you could see the start of a broader bear market. Now that's just a base case. Things could change based on policy shifts, but that's kind of what I'm seeing. I don't see this because of where credit markets are, where broader liquidity is, especially with the Treasury General account likely being drawn down due to the debt ceiling being hit. A lot of people think the debt ceiling being hit is bad. It's actually good for liquidity in the near term because the Treasury General account, which is the Treasury checkbook, is now spent into the economy without the Treasury issuing debt in order to pull liquidity out of the economy. And so it tends to be like a one-way street until you reach that impasse, or you resolve the situation, and then the Treasury starts to issue debt again, and that could be a catalyst for liquidity dynamics to become more negative. But in the near term, it's still relatively positive, and that's why this pullback not likely to be something that brings a major drawdown in equities. Now, do you get down to 5,400 and then a rally to maybe the previous highs at the end of last year? That certainly could be possible as well. So, that's the pattern I'm generally looking for. But you kind of have to. You can't get too far ahead of the market. You have to kind of call the balls and strikes as they're thrown at you, and that's kind of what I'm seeing right now. What else do I want to get to? So the Nasdaq here. The Nasdaq has been weaker, but I think that's where you're going to see most of the sell-off this year. Let's look at the SMH. This is a bear flag here. You have that move down in July, and this is on a weekly chart. a bearish wedge, right? Look at the MACD. Look how weak that is, okay? And you got that reversal this week. I definitely could see, and NVIDIA would be the catalyst, right? NVIDIA had a big reversal candle this week. Now it didn't close below yet last week's low, which will be, the kind of the key number. If you get, I think, 2 consecutive weekly closes below last week's low, that would be a bigger sign that NVIDIA has topped. But this is certainly a modestly bearish pattern over the past few days. And look at the MACD threatening to break that zero line. And when it breaks the zero line to the downside, that means it is in a downtrend. And so something I'm watching and certainly will weigh on the indexes as a whole if that does break lower. Tesla with a pullback, but found support here near term. So I don't see anything, see any major issues with that. Let's take a look at Netflix. That was weak. That is kind of falling out of bed here. So I would be a bit bearish on Netflix, that's for sure. Amazon, that is kind of falling along the lines of the Nasdaq, so modestly bearish, but not a terrible pattern overall. Apple into support, reversed decently. We'll see if we break that 100-day moving average. If we do, obviously the 200 is that next support level, but broadly it's still in a pretty good uptrend, so I don't really have a major issue with Apple. Let's take a look at Meta. That was strong this week overall. Definitely probably the strongest pattern of the major tech names that are out there. Let's take a look at Google. Google relatively strong as well. Nice bullish consolidation pattern so far. So I wouldn't get too bearish on Google just quite yet. What are the other Mag 7 names that I'm missing? Am I missing any? I'm sure I'm missing some. I don't want to miss any for you guys. Let's go here, market cap. If you look at Broadcom, Microsoft, that's the one I was looking for. Microsoft, yeah, Microsoft, that's definitely looks more neutral to bearish. And then Broadcom. Broadcom, if we break into this gap, this is going to fill that gap, head back to where it was pre-earnings. So I think the AI train in general is certainly struggling, and a lot of that hype could be set to come off this year, and that would certainly weigh on markets overall for 2025. I do think this is going to be a very different year than 2024. It's going to be choppier. It's going to be more volatile. It doesn't mean it has to be a terrible year. I think there can be very good pockets of strength, but don't expect this to be a raging bull market. There's just the rates being so high. Look at the sell-off in bonds. Kind of similar to what we saw. I'll zoom out to a weekly chart. Right, this not as intense of a sell-off as we saw in 2021 and 2022, but if you get a broader sell-off from here, that could certainly weigh big on equities. Now, once again, I don't expect it to be as bad as 2022 on the equity side. I just expect it to be choppier with a lot of pockets of strength, a lot of pockets of weakness as well. A lot will depend on what happens with the dollar. If the dollar can weaken, that will bring a lot of strength to commodity markets, base metals, precious metals, industrials, etc., but would probably precipitate a continued sell-off in kind of the big tech names and the Mag 7. So something I'll be watching, and the big swing factor in this year's market will be the dollar overall. I think that's about it. I'll leave it there. I appreciate you all tuning in, liking, and subscribing once again to our podcast and this video. And a reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.